The stochastic oscillator is one of the most straightforward and widely used tools for measuring momentum and finding potential entry points. It appears in its own panel below the chart and shows you how the current price is behaving inside its recent trading range through two dynamic lines. But to really take advantage of stochastic, it is not enough to just watch for crosses or overbought and oversold levels. You need to see how the values are built, how %K and %D are calculated from highs and lows, and what those changes actually signal about market conditions. In this video, part of our series, The Best Trading Indicators Explained, step by step, we will break down the stochastic indicator in detail. You will follow the full formula on the chart with our custom calculation table and see how it plays out in live market situations. Clear rules, less confusion with a practical explanation that finally makes sense. Let's begin by adding the stochastic oscillator to the chart. On TradingView, open the Indicators menu and type Stochastic in the search bar. You will notice two different indicators. One is simply Stochastic and the other is Stochastic RSI. For this lesson, make sure to select the one labeled just Stochastic under the Technicals category. That's the official built-in stochastic oscillator provided by TradingView. By default, stochastic uses a 14-period %K length, a %K smoothing of 1, and a %D smoothing of 3, all based on the current chart's price highs, lows, and closes. Once the indicator is added to your chart, hover over its name and click the gear icon. This opens the settings panel where you can fully customize how stochastic behaves and appears. Now let's go over the full settings of the stochastic indicator, starting with the Inputs tab. At the top, we have %K length. This controls how many periods are used to calculate the lowest low and highest high range that %K is based on. The default is 14. Next is %K smoothing, which applies a simple moving average to the raw %K calculation. By default, it's set to 1, meaning no extra smoothing is applied. Then we have %D smoothing, which calculates a moving average of %K to create the %D line. The default value is 3, giving you the standard signal line that traders often look at for crosses. Under calculation, the time frame is set to chart, meaning the indicator will follow whatever time frame you're currently viewing, whether 5 minutes, 1 hour, or daily. The checkbox, Wait for time frame closes, ensures values are confirmed only after each candle closes, which helps reduce noise. Finally, under Input Values, the option Inputs in Status line lets you show or hide the indicator's parameters and real-time values at the top left of the chart. It's useful to keep this enabled for quick reference. Now let's switch to the Style tab. Here you can customize how the stochastic indicator appears visually on the chart. At the top, you'll see checkboxes for %K and %D. These control the visibility of the two lines that make up the stochastic oscillator. You can enable or disable them individually depending on your preferences. Next to each option, you can customize the color, line thickness, and line style. By default, %K is blue and %D is orange. Below that, you'll find options for the upper band, middle band, and lower band. These horizontal levels are set to 80, 50, and 20 by default. They help you quickly identify overbought and oversold conditions. You can show or hide each band and adjust their color, thickness, or style. There's also a checkbox for background. Enabling this shades the area between the upper and lower bands, making it easier to interpret when price momentum is stretched to extremes. Under Output Values, the precision setting lets you control how many decimal places are shown for the indicator's values. The default option adjusts automatically based on the instrument and is usually the best choice. Finally, you have two additional display options. Labels on price scale adds markers on the right-hand side of the chart showing current stochastic values. Values in Status line displays the real-time values and parameters of the indicator in the top left corner for quick reference. Finally, we have the Visibility tab. This tab controls which time frames the stochastic oscillator will appear on. You will see options for ticks, seconds, minutes, hours, days, weeks, and months. Each row lets you set the visibility range, such as from 1 to 59 minutes or from 1 to 24 hours. If a box is checked, the stochastic will be visible when that time frame is active. If it is unchecked, the indicator will be hidden during that range. At the bottom, there is also a ranges option. This allows for more advanced visibility control, but in most cases, you will not need to use it. With all these settings adjusted, your stochastic oscillator is now fully configured and customized. In the next step, we will look at how the stochastic calculation actually works. Now that we have the stochastic oscillator on the chart, let me explain what you are seeing in this custom calculation panel. This panel shows how Stochastic is built step by step, and it also checks our math against the TradingView reference. At the very top, you see the inputs: %K length, %K smoothing, and %D smoothing. These are the same settings used by the built-in Stochastic on TradingView. Right below that, you see C0, H0, and L0. Those are the close, the high, and the low of the current bar. The close is the price that feeds the raw %K calculation. Step 1. We find the lowest low over the lookback and the highest high over the same lookback. These two values define the recent price range that Stochastic uses. Step 2. We compute the denominator. Den equals HH minus LL. That is the size of the range. Step 3. We calculate the raw %K. The formula is 100 times close minus LL divided by HH minus LL. If the denominator equals 0, %K raw is set to 0. This places the close on a scale from 0 to 100 inside the recent range. Step 4, we smooth %K raw using a simple moving average with the chosen %K smoothing. If smoothing is 1, there is no extra averaging. Step 5, we compute %D. This is a simple moving average of %K using the %D smoothing setting. Traders often read the interaction between these two lines to judge momentum. And below the steps, the panel prints diagnostics. It shows the LL and HH that were found and how many bars ago they occurred. It also shows the current denominator and the current raw %K that came from those values. Next, you see a verification line for %K and another for %D. On each line, there are three parts: %K or %D calculated manually, %K or %D from the TradingView reference, and the delta. The reference uses TA.stock followed by SMA, which matches the built-in Stochastic. Delta should be 0 or very close to 0. If delta is not 0, check your inputs and the price source. At the very bottom, there are quick notes that summarize this check. They remind you that all stochastic values are on a 0 to 100 scale, and that a non-zero delta usually means a setting mismatch. For any trader who wants to go beyond simply following signals and really understand them, this kind of breakdown is essential. On this chart, you can see the two lines that make up the stochastic oscillator. The blue line is %K. This is the fast line that reacts quickly to price changes. The orange line is %D. A moving average of %K that smooths the signal. When the blue %K line crosses above the orange %D line, it often suggests bullish momentum. When the blue line crosses below the orange line, it can point to bearish momentum. Notice also the horizontal levels at 80 and 20. When both lines are above 80, the market is considered overbought. When both lines drop below 20, the market is seen as oversold. The key is not just watching for crosses or levels, but understanding the context. If the blue %K stays above the orange %D and holds near the top of the scale, momentum is strong. If it falls sharply through the orange line, it may signal a change in direction. With just these two colored lines, blue for %K and orange for %D, Stochastic gives you a quick visual snapshot of market momentum. Now this is crucial, and it needs to be crystal clear. One of the most common mistakes traders make with the Stochastic Oscillator is treating it like an automatic buy or sell button. They see the blue %K line cross above the orange %D and jump into a trade, or they see it cross below and rush to exit without looking at anything else. That's not what Stochastic was built for. These lines are not magic triggers. They are momentum signals, tools to help you read where price is closing inside its recent range. If you use them blindly, without context, you're setting yourself up for failure. This is why so many traders lose money with Stochastic. They buy just because the lines are above 80. Even when the move is already overextended. They sell just because the lines fall below 20, even when the market is only consolidating. That's not discipline, that's chasing signals. To use Stochastic the right way, you need context. You need to see the bigger trend, the market structure, and how price is behaving. You need to ask, is this move showing real momentum or is it just noise? Is the market trending strongly or just chopping sideways? Here's the truth. Stochastic becomes powerful when it's combined with other tools: price action, moving averages, volume, or volatility filters. That's where strategies start to take shape, and we cover those in separate videos. But the goal of this video is different. This video is about the foundation, understanding exactly what Stochastic shows you and the risks of misusing it. Because no matter what system you trade, knowing the math, the logic, and the behavior behind the indicator is not optional. It's essential. And that brings us to something we'll repeat in every video of this series, because truly understanding this one principle can change the way you trade. If you've already heard this message and it resonates with you, feel free to skip ahead. But we strongly encourage you to stick around and even replay it until you can repeat it by heart. This isn't just theory, it's the foundation of consistent, sustainable trading. Here's something every trader needs to hear, especially if you're just starting out. Indicators are not magical signals. They don't predict the future. They simply reflect what's already happened. They're tools, valuable ones, but still just tools. They help you read context, not control outcomes. The real problem begins when traders expect certainty, when they treat indicators as if they guarantee success. That mindset leads to frustration, disappointment, and an endless cycle of jumping from one strategy to another. To really understand why this happens and how to avoid it, let me share a powerful idea from Mark Douglas, one of the most respected voices in trading psychology. He once explained that many traders believe their system or indicator told them what was about to happen. But in reality, the market moves because of the conviction, or lack of it, between buyers and sellers, not because of any mathematical formula. He pointed out that most of the reasons we hear in financial news are just stories made up to sound logical after the fact. And this illusion of certainty is what makes traders feel betrayed by their systems, thinking the methodology failed them, when in fact, no technical method can predict what will happen next on a trade-by-trade basis. As Mark said, technical systems only tell you what's likely to happen over a series of trades, never the next single one. And just to show how unpredictable the market really is, Mark once told a story about a trader he mentored. This trader was an excellent analyst, one of the best Mark had ever met, but he struggled to execute trades successfully. So Mark advised him to focus on analysis instead of trading other people's money. The man followed his advice and became an analyst for a major firm at the Chicago Board of Trade. One day, the firm's chairman, an old-school grain trader, sat down with him. The chairman was skeptical about technical analysis and wanted to see how it worked. As they watched the soybean market move within a range, the analyst confidently said that the current price would be the low of the day. The chairman laughed, picked up the phone, and ordered the sale of 10 million beans, 2,000 contracts, instantly driving the price down 10 cents. Then he turned to the analyst and said, "If I can do that, anyone can." And that's the lesson. Sometimes it takes just one player with enough size or conviction to completely destroy your perfect setup. So, the next time you find yourself waiting for that perfect signal, remember this: it only takes one player with enough power to make your setup irrelevant. That's why mindset matters. That's why context matters. And that's why indicators, no matter how popular, are tools, not crystal balls. And that wraps up our breakdown of this indicator. In every episode of this series, we'll keep reinforcing the same core message. Indicators don't give you an edge. How you use them does. To help you move from theory to practice, check the card above and the description below. We've linked real strategies that use this indicator in action. And if you want to keep growing, take a look at our full training programs. We've got smart money concepts to help you understand how the big players move the market. Technical analysis for day traders, focused on fast, practical decision-making. The Wyckoff method, to help you read price and volume with structure. And most importantly, our complete trading psychology playlist, because no matter what strategy you use, mindset is what makes it work. Take the time to study. Focus on building real skill, not chasing shortcuts. Because at the end of the day, it's not the indicator that makes you profitable. It's how well you understand and use it. I hope you enjoyed today's video. If you found the content helpful or engaging, please give it a like, as this helps the video reach more traders like you. And don't forget to subscribe to the channel and turn on notifications so you never miss our latest insights on the markets and practical trading strategies. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Now, if you want to go even deeper and get access to exclusive content, early video releases, and extra tools to support your journey, consider becoming a member of the ComLucro Trader community right here on YouTube. It's a way to support our work and a smart investment in your own development. Thanks for watching, and I'll see you in the next video.